From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, Powell and Pierce say the inflation fight is far from over, with Wall Street divided on where yields go next. And coming up, our exclusive interview with Oaktree Capital Management incoming co-CEO Armen Panossian. We begin with the big issue, barreling into the second half.
We're seeing disinflation.
That report this morning was very good.
The three waves of inflation that we've had, the demand shock after the pandemic, the supply shock of the war, and then the profit-led inflation. Wave one and wave two have gone.
Things are continuing to be much, much better than expected.
Don't think that this is the end of the bull market.
The economy is pretty robust.
From a fundamental perspective, I don't think an awful lot really has changed yet.
Our call is that the Fed would probably stay in and around, the at current levels.
The Fed is being very vigilant in terms of keeping rates high.
It's not out of the question that they raise rates by maybe 25 basis points or even 50 basis points by the end of the year.
We are looking at a new interest rate regime moving forward.
I think it's a relatively hawkish message still.
Clearly, the ECB is going to hike at least twice. Bank of England is going to hike at least twice. I really hope the Fed doesn't.
The Fed is very committed to keeping policy higher for longer.
Whatever this is, whether it's a recession or a growth scare, I do think it's starting.
We're very cautious.
There's a lot of stuff on the table.
Joining us now, we have PGIM's Robert Tipp and JPMorgan's Kelsey. Berro, great to have you both with us. Robert Tipp, I want to start with you because we heard it from Powell himself. We had the opportunity to hear from the Fed chair multiple times this week. The possibility of 2 or more hikes is very real. Have you changed your expectation of where terminal ultimately is in the past week?
No, we have not. I think the news is coming in favorably, a little bit better than people hoped for in terms of growth, which you might think would put upward pressure on rates, but they're getting a little bit of cooperation on inflation too. So I think that there are things people are missing about the outlook here and the Fed themselves with the dots that they're missing about next year and the year after that. But in terms of this year, I think he's keeping the markets on guard. They want to have the latitude to raise rates without shocking anybody if they need to. But they're hoping that, they could do one and be done. But that kind of looks like the course here. No changes based on the data that we're getting here.
Well, Kelsey, we have all of the data in front of us, and you think about what we saw in the past week, jobless claims not falling as much as expected, and then PCE, though, maybe a little bit of good news this morning. When you put that together and think where the Fed should go, what's your opinion?
So it's likely that the Fed is going to hike again in July. But to us, what we're really focused on is trying to determine how restrictive monetary policy really is at this juncture. And we look across a variety of different ways of measuring how restrictive policy really is. And what we're finding is that policy is actually already very restrictive. And what the Fed is doing now by continuing to hike rates as inflation is coming down and as the leading indicators are rolling over, suggesting lower growth and lower inflation in the second half of the year, is that they are over-tightening monetary policy. Policy is already restrictive. The Fed's going to try to push it a little bit more in July. But ultimately, to us, the leading indicators are clear. The yield curve is inversion is telling you that slower growth and lower inflation are ahead.
Well, Kelsey, what are you looking at to judge that, just how restrictive monetary policy is? Because you look at financial conditions, market-based measures, they tell one story. Then you look at real yields, for example, and they tell a little bit of a different story. What are you using to judge?
Yeah, exactly. I mean, I've had my eye on 5-year real yields all week. They have been testing that 2% level. That's the cycle high for the year. That's also kind of a multi-decade high for real yields. And to us, that signals that policy is restrictive. But there are other ways to look at it that we're assessing. So for instance, if you look at the nominal Fed funds rate and you compare it to market expectations for inflation over the next year, or I should say consumer inflation expectations for the next year, and we saw the University of Michigan one-year expectation is really starting to drop now. It's down to 3.3%. You compare that with Laubach-Williams' measure of the neutral rate. And we've actually found that the policy restrictiveness relative to that neutral rate using a one-year real policy rate is actually the most restrictive going back to the 1980s. Another thing that really caught my eye recently, looking back at some of this Fed research that has been published over the past week, they're noticing it too. The number of distressed firms is highest since 2008, 37%. And what that means is you combine that level of distress that's starting to bubble up in the corporate America world, and that's suggesting that aggregate demand is going to moderate and this tight monetary policy is going to bite.
Well, we are starting to see that again if you're using real yields to judge. I want to talk about that 5-year real yield. Kissed 2% earlier, the highest level since 2008. And Robert Tipp, let's wrap this into a view on the markets. We heard from JPMorgan a little bit earlier. JPMorgan strategists are unwinding their long position in 5-year treasuries, writing, quote, "We can no longer justify our tactical long duration view. Treasuries have outperformed their underlying drivers and valuations remain rich. Positioning is long, indicating that there could be risks of long liquidation in coming days." Robert, when you look specifically at the belly of the curve and a little bit longer, what's your read? Are you staying away, or do you think that now is the time to extend?
Yeah, I think you have to cut the bologna a little bit more finely here. Big picture, rates are up a ton. The Fed has hiked 500 basis points, and they're getting some of the things that they want to see. And there's a good chance that we're going to be here for a very long time. Yes, rates are up a lot. There is churning within the economy. The residential real estate sector has slowed down. But when you look at what we've seen this week, durable goods are phenomenal. You're getting some increase in jobless claims, sure, but we were at an unsustainably strong labor market. So things are moderating. I think people have been trained this century to assume that every time you get a tightening of monetary conditions, you're going to have a recession. And they're not used to seeing an environment where interest rates go up because they needed to go up. And that's what we've seen here. They were a couple percent lower than they needed to be for a couple years longer than they needed to be. But the Fed wanted to make sure the economy was running well and that they weren't going to have another 25 years of inflation below target. Waited a little bit too long. Then they definitely needed to hike 300 basis points from 2%. And that's where they are. So it's kind of like a mid-90s environment where there's a lot of financial dynamics, a lot of concerns churning within the economy. But ultimately, this is going to power along. So I think getting to your question on the yield curve shape, the middle of the curve is not an attractive place to be. You're going to have a situation here where the roll is going to burn people. But strategically, the level of yields in the bond market is very wholesome here.
Definitely a different dynamic than I've been hearing about over the past few weeks. I've been talking to a lot of belly bulls, but they're not as loud as they had been. But I want to bring you guys into a debate I've been having over the past few days, where the 10-year Treasury yield is going to go. We heard from Bill Dudley, former New York Fed president, writing in his latest Bloomberg opinion column, quote, "Suppose the Fed's short-term interest rate target, adjusted for inflation, averages about 1% over the next decade. Inflation averages 2.5%, and the bond risk premium is 1 percentage point. In sum, this suggests a 10-year Treasury note yield of 4.5%. And then on the other side of the trade, you have Subhadra Rajappa of SocGen taking the other side, writing, quote, "We expect yields to gradually decline over the coming year as we retain our call for a 3.5% 10-year Treasury yield by year end. The yield curve should gradually steepen, turning modestly positive next year as the Fed lowers policy rates in a recessionary context." So a lot of words there, guys. But the takeaway is you have Dudley 4.5%, SocGen 3.25%. Kelsey, Berro, where do you fall?
Yeah, so maybe for a second we can just take a step back because we are halfway through 2023. And what we've seen so far this year, the Fed has hiked rates 75 basis points and the 10-year yield is lower. It's lower by 5 basis points. So what you're seeing is as the cycle extends, the sensitivity that the 10-year yield has to front-end yields is falling. In fact, as you get towards the end of the cycle, it actually, that correlation, it turns negative. So we think from here, the bulk of the repricing in the 10-year yield is already behind us. And in fact, as the Fed approaches the end of the cycle, what we should be seeing is yields start to move lower. So we'd be in that camp of expecting yields to move gradually lower over the course of the year.
Robert, weigh in on that. When you look over the rest of 2023 as we approach the second half of the year, is the next leg for yield, specifically the 10-year yield, higher or lower from here?
Right. I think you're going to be looking at a lot of stability. I think the prevailing wisdom out there and the consensus forecasts, if you use the ECFC Bloomberg function there, you'll see people are looking for pretty aggressive moderation in growth, moderation in inflation, and lower yields ahead and cuts from the Fed, like the Fed in their dot plot themselves, like they are showing 1 and 2 and 3 years out. But I think the reality here is that we've shifted. And, we've just come from, and how long does it take the market to get on the right side of that? I think we just saw the markets grapple for 40 years on the wrong side of the yield curve. From the 1980 period all the way down, people expected rates to be stable or move back up. The consensus was generally not below spot interest rates. And it took them a long time to figure out the Fed wanted disinflation to stop. The Fed was going to keep engineering a lower and lower interest rate environment. And prior to that, the market was slow to see the inflation. Right now, I think what the market is slow to read is that the Fed is going to be at 5% or so for a very long time. The market does understand, investors see that, hey, if I'm getting diversified fixed income, if I'm buying high yield, I'm getting a tremendous yield, I'm going to outperform cash over the long term. I agree with that. But corporate product and spread product providing good long-term competitive returns is not inconsistent with there being a little bit of upward pressure on Treasury yields over the next 1, 2, 3, 4, 5 years.
All right, guys, really great discussion. Appreciate your time. That is Robert Tipp and Kelsey Berro. Thank you both so much. Up next on this program, we have an exclusive interview with Armen Panossian, the incoming co-CEO of Oaktree Capital Management. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block as we wrap up the month, the quarter, and the first half of 2023. We start in Asia, where foreign borrowers are raising a record amount of yuan debt in China. Lower rates and looser rules boosting the appeal of that market. In Europe, issuance surpassed 1 trillion euros. The region hit the mark despite today marking the first session without sales, ending the longest streak since 2021. And here in the U.S., we saw a bit of a summer holiday slowdown to close out the month. June issuance, though, came in at just over $90 billion, and the year surpassed $700 billion in sales. I'm pleased to say that joining us now for an exclusive interview is Armen Panossian. He is head of performing credit at Oaktree Capital Management, which is one of the largest distressed investors in the world. And it was just this week, it was announced that he will be co-CEO of the firm starting in the first quarter of next year. Armen, great to have you with us. I want to get to your views on the market, but let's talk about the news of the week, the co-CEO label. First of all, congratulations. It's not a label we see too often, a co-CEO. How is it going to work at Oaktree?
Thank you, Katie, and I appreciate the opportunity to be on Real Yield. The co-CEO designation at Oaktree, yes, it is a new one, and you often don't see it. But myself and my partner, Bob O'Leary, who have been at the firm now 16 years in my case and over 20 years in Bob's case, we have worked together directly in our opportunities group for many, many years. And several years ago, I moved over to the performing credit strategies. Our partnership is very strong across all things Oaktree. We work very closely with both our credit areas and our non-credit areas, as well as our non-investment areas of the firm, having been here for so long. So we're not really dividing the world in terms of the opportunity set or the responsibilities. It is truly a partnership. But I will continue to oversee the performing credit strategies, and Bob will continue to see the opportunities group. And I think there's a tremendous amount of opportunity collectively at Oaktree, given the current market environment and the economic backdrop. So we're really excited to move forward and have to really build on the 30-year history of Oaktree, built by Howard Marks, Bruce Karsh, and the other co-founders. We're on really solid footing and excited and humbled by the opportunity to lead the firm going forward.
Well, let's talk about some of the opportunities in the market, because just a couple of weeks ago over at Super Return in Berlin, you called this period that we're in a new era of tight credit markets. Where are you seeing that tightness right now?
Yeah, we're seeing it across multiple areas. So first and foremost, the liquidity in the market is meaningfully lower today than what it was pre-COVID or even in 2021. We're not seeing a lot of trading volume. We're not seeing a lot of new issuance in high yield bonds or in senior loans. And part of that is because there just aren't willing borrowers. And in the case of M&A activity, we're not seeing willing sellers at what are today depressed valuation multiples. It's really because at this point, we have hit a massive inflection point around rates, where we've had the inversion or the reversal of 40 years of downward movement in rates and about 12 or 13 years of easy money in the markets. With the rapid inflation that we've seen in the economy, the Fed, and they've said as much even this week, the Fed is very much of the opinion that it needs to raise rates to battle inflation to get to the point where we actually have real rates. In other words, rates in excess of the nominal inflationary picture. So that's, go ahead.
I was just going to say, of course, we've seen extraordinary happenings on the monetary policy front. I'm really curious, though, in the time that we have with you, to hear your thoughts on what we've seen in the banking sector, because I know you've made the point in the past that you're expecting tougher regulation ahead for U.S. banks. What opportunities would you expect that to create? And are you seeing those opportunities surface already?
Yes, absolutely. In the case of investment banks that use their balance sheets to commit to deals, to syndicate to investors in the broadly syndicated side, a broadly syndicated loan side, or in the U.S. high yield bond side, we are seeing a reduction in access to those balance sheets and a reduction in the new issuance volume seen from those banks. It's really because the hung loans that were placed on the balance sheets in 2022 and were placed at massive discounts into the market in late 2022 and early 2023 really created a big hole in the bank balance sheets in the billions of dollars. And therefore, the risk desks and regulators are watching this very closely. In the case of the commercial banks or regional banks in the U.S., they have tremendous amounts of real estate loans and other corporate loans, as well as a Fed that has articulated a higher level of equity capital needed to manage those banks. And as a result, what we're seeing how that play through in the markets is a reduction in lending activity by commercial banks across the board, in real estate as well as corporate lending, which allows for private lending, non-regulated entities like investment managers such as Oaktree to step into that void and partner with banks in some cases, as well as just lend directly to borrowers for real estate as well as corporate lending that no longer have that incumbent lender available to them.
And I want to get to fundraising, but just quickly on that point, have you started to see banks start to offload some of that loans? There's a great story on the terminal to that effect, that basically you're seeing that already happen. Is that something that Oaktree is trying to take advantage of?
Yes, we have seen it begin, but it's only the beginning. I think the depth of that opportunity is yet to come. There have been some transactions. There have been many conversations. As well as discussions about partnership between the private lending universe, asset manager universe with banks. But there are transactions of portfolios in both real estate and corporate lending that have already occurred. And based on the conversations, I think will continue to occur at a more rapid clip over the course of the next few quarters.
We'll hope to have you back to talk about those conversations. But let's talk about some other news from Oaktree in the past couple of days. You also announced the close of Oaktree's Life Science Lending Fund for $2.3 billion. Tell us a little bit about that sector and what are you looking at there?
Life sciences is an attractive industry from a lending perspective for multiple reasons. First of all, it requires specialized knowledge, and therefore it's a less efficient marketplace for competitors to lend in. We're able to get more attractive legal terms, better pricing, lower loan to values than you would typically see in other asset classes in the lending universe as a result of that. Second, life sciences companies are not GDP correlated. If a company is good at curing cancer, saving lives, changing lives, doesn't really matter if we're in a recession or having some sort of broad market dislocation. From a credit perspective, the company's performance makes it such that our loans to these businesses are well covered. So we really like that from a diversification standpoint in a broader credit portfolio to have uncorrelated assets that will not kind of have the same outcome as an industrial or consumer business might. So those are the two main reasons why we really like it. And the third, I would say, is there has been a meaningful reduction in the valuation multiples for these businesses since the pandemic. During the pandemic, they rallied very hard, and since then they are off 50, 60, 70%, which means that the cost of incurring or the cost of raising capital in the equity markets is prohibitively expensive for these companies at this point and too dilutive. And therefore, finding alternative solutions like the ones that we offer at Oaktree in our life sciences business are very attractive at the time, and we're seeing a meaningful increase in our deal pipeline.
Armen, it's great to get some time with you. Hope to have you back soon. That is Armen Panossian. Thank you so much. Still ahead, it's the final spread. The week ahead, key data including U.S. jobs. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, we have markets closed on Tuesday for the 4th of July. Wednesday, we get Fed minutes. Thursday, JOLTS data. And Friday, it's the U.S. payrolls report. Let's take a closer look at that jobs report. Not quite the blowout that we saw in the prior month, but it's really that average hourly earnings print that you want to watch. But that's next Friday. And from New York, that does it for us. We'll be here same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.